Hey everyone, welcome to this explainer. Today, we're decoding the latest data to map out the fascinating and honestly kind of paradoxical Indian equity market for 2026. Look, if you follow the markets, you already know the headline numbers rarely tell the whole story, right? So we're going to strip away the noise, dig into the actual data, and figure out what's really driving the currents underneath. All right, let's dive right in with a massive macroeconomic tailwind. The RBI has seriously eased up on liquidity, slashing repo rates by 125 basis points this year. I mean, that's not just a minor tweak. According to the HSBC Asset Management Report, this shift is already juicing up credit growth. Plus, with inflation staying pretty benign, it actually opens the door for even more rate cuts down the line. Keep this in mind, because this is essentially the foundational backdrop for the whole shebang today.
So here's our roadmap for today. First, India's 2026 market outlook, then we'll check out the tech sector and that big Infosys transition. After that, we'll unpack the HDFC Bank profit paradox and wrap up with the top Nifty 50 stock picks.
All right, starting off with Section 1, India's 2026 market outlook.
So, right off the bat, we're seeing this really stark market divergence. While the Nifty climbed a very respectable 12% by late 2025, small caps actually dropped 5%. So yeah, that old saying about a rising tide lifting all boats, not happening here. We've totally shifted from a broad market rally into a highly selective environment. Picking the right sectors and stocks is literally crucial for your portfolio right now. But hey, despite all that market choppiness, India's growth momentum is still surprising everyone on the upside. We hit 7.8% for Q1 and an absolutely impressive 8.2% in Q2 of FY26. To put that in perspective, this underlying economic engine is just incredibly robust right now. It provides this really strong floor for market valuations, even when certain sectors hit a rough patch. Now you might be wondering, how are the big players handling this? Well, HSBC is leaning into consumer discretionary as an overweight position. Why? Mostly because a solid monsoon and low inflation are really boosting rural confidence. Oh, and of course, that massive shift toward quick commerce is helping too. On the flip side, they're staying underweight on metals. They figure, sure, prices could go up, but that potential upside, it's pretty much already baked into the current valuations. Moving right along to Section 2, the tech sector and the Infosys transition.
For a prime example of what's happening in tech, let's look at Infosys. They just posted a super robust 12.2% year-over-year jump in net profit, hitting a massive 7,769 crore in Q1. Now remember, we're in this tough global macro environment where everyone said discretionary spending was going to be super tight, but these numbers, they're undeniably strong and show some serious resilience in their core business. But here's where it gets really fun. We're finally seeing AI turn into actual, tangible business gains. It's already making up 8.2% of their total revenue. So yeah, we're way past the phase of just throwing AI around as a buzzword. It's actually driving serious, measurable cash. Management even pointed out that their specific AI strategy is directly leading to consistent market share gains and landing some huge deals. And to steer this whole new era, Infosys mapped out a major leadership transition. Ashish Kumar Dosh is stepping up as CEO designate in July 2026. This gives them plenty of time for a seamless handover before he officially takes the reins in April 2027 for a full 5-year term. Honestly, having such a long runway for this change shows a really calculated, stable approach to their corporate governance. Chairman Nandan Nilekani backed this up with a pretty telling quote. He emphasized that they needed an internal leader, someone who could drive this bold AI transformation but still have the judgment to protect their core values and customer trust. Think about it. The IT industry is dealing with insane disruption right now. Finding that sweet spot between bold change and rock-solid trust is exactly what the board is aiming for here. All right, Section 3, this is a fascinating one, the HDFC Bank profit paradox. Okay, this is the ultimate head-scratcher for retail investors. How on earth does a bank post nearly 20,000 crores in profit, which is a 5% increase from last year, by the way, but then watch its stock just tank over 5% right after the earnings call? If you're just skimming headlines, it makes zero sense. But here's the catch. The market isn't reacting to what HDFC made today. It's reacting to what those numbers signal for the quarters down the road. So the key puzzle piece here is their net interest margin, or NIM. It dropped to 3.26%, which is actually its lowest point since the big HDFC Limited merger. In simple terms, NIM is just the gap between the interest the bank makes on loans
and what it has to pay you for your deposits. Because that margin is shrinking, they're basically making less profit on every single rupee they lend out, even if the total amount they're lending is going up. And making that margin squeeze even worse, their CASA ratio dropped to 32%. Now, this is a super vital metric. It means that for every 100 rupees sitting in the bank, only 32 bucks are from those cheap current and savings accounts. The other 68 rupees, they're coming from much pricier term deposits like FDs. So actually getting the money to lend out is getting way more expensive for the bank, and that directly eats into those profit margins we just talked about. Now, let's be fair here, HDFC isn't broken, not at all. Their core asset quality is fantastic. I mean, gross NPAs are sitting at an incredibly low 1.17%, and their corporate lending is still rock solid. But the market is hyper-focused on the weaknesses right now, that intense margin pressure and a slower retail lending environment. Basically, investors are punishing the stock because it's just going to take a lot of time for those profit margins to fully bounce back after the merger.
Which brings us to Section 4, our top Nifty 50 stock picks.
So based on what the analysts are projecting, financial stocks are just dominating the top targets right now. Interestingly enough, HDFC Bank actually shows a massive 28% potential upside as a deep value recovery play. Then you've got Axis Bank looking at a 22% upside and Bajaj Finance at 19%. Oh, and breaking up the banking party is consumer giant HUL. They're poised for about a 19% jump, mostly because those raw material costs are fading and their sales volume is finally recovering.
As you can see, those surface-level numbers almost never tell the whole story. Whether it's a giant bank profit masking a serious margin squeeze, or an IT titan quietly building up a massive AI empire, the devil really is in the details. So armed with this deeper dive into the data, I want to leave you with a question. How are you going to adapt your strategy to capitalize on all these shifting dynamics in 2026? Think about it. Thanks so much for joining me for this explainer, and as always, keep looking beyond the headlines.